Hey guys, welcome back. In today's video, we are talking about how shorts lost this week, Citadel losing money, the AMC swaps increasing, and many more in this video. First, we're taking a look at this. If AMC closes above 260, the market managed to call shorts bluff. They never had the power to move AMC even close to this week's max pain at 250. Excellent news for what's to come. They're losing, we are winning. So we talked about the max pain this week for AMC, which is at 250. As you can see, AMC actually closed at 280 for the week. So we are way above max pain. Now, the shorts have been fighting for max pain. We've seen this throughout the past few weeks, especially last week as well when we talked about it. And so the very fact that we are seeing them failing to bring AMC below max pain is obviously very excellent news. The reason for this is we've talked about shorts are put into pressure when AMC closes above max pain, they are losing money. But more importantly, when they don't have the ability to put AMC below the max pain, it shows that they are running low on liquidity, they're running low on their capital to utilize the strategy that they previously used to obviously suppress AMC. So what we're seeing right now is the methods and the abilities for these short sellers to continuously suppressing AMC is slowly running out, and it will come to a point where they won't have any more capital, any more liquidity to suppress anymore. And so this is obviously a very, very good sign. Now we have to see this multiple times. It isn't just a one-time thing and then suddenly, we're saying that shorts have no more money, but it's a progression of things to come. And we're going to be looking at other things which showcases furthermore how shorts are obviously running out of money. And at the end of the day, when we talk about when shorts are running out of liquidity, it means closer to margin calls. It means that they have no longer the ability to suppress AMC, meaning real price discovery. So plenty of good things come along with indications of how shorts are, of course, losing capital. And then we're looking at this. So this is another reason why we are understanding that shorts are losing money. You can see Citadel Securities reported a slump in second quarter net trading revenue. Net trading revenue declined 8.4% in the second quarter to 2.39 billion. Second quarter net income fell 23% to $922 million. So obviously these numbers are still very, very big. However, what we've seen is the firm who once obviously exploited these strategies to make their money are seeing difficulties right now, and they're seeing declines in their money. Now, this doesn't come to us as a surprise. We've covered multiple things about them already. We've seen how, firstly, Citadel has been very vocal about fighting the cat system, which we talked about. The reason for that is because it exposes all of the strategies they do, which are bringing it to plain sight, whether it's to just the general public or to the regulations. And whilst the regulations aren't taking extreme actions, it is still something that is slowing Citadel down. And then we've also talked about how Citadel are complaining about other various factors as well, like the private trading rooms are done by these other small firms who are doing it more successfully and of course actually doing it right and making money, unlike Citadel. And so multiple things. And now then on top of that, the most important thing is obviously the fact they are failing to make money with their short position and the swaps, especially the ones that contains AMC and GME. And is why we are seeing them decreasing in their income, decreasing in their revenue, because of how much pressure we've applied to these guys, because of how much money we've forced them to spend just to keep AMC at where it's at. Every day, they're fighting for a 2-cent drop on AMC. You can pretty much see for the last few days, a 2-cent drop on Friday, a 1-cent drop on Thursday, a 2-cent drop on Wednesday, a 2-cent drop on Tuesday, and then the biggest drop, which was 7 cents, which is obviously on the Monday. And so this is what they're trying to do. They're trying to bring AMC down with a vast amount of money, but they don't have that ability to do so anymore. Remember, when they try to bring down AMC 2 cents, they've done this by spending tens of millions of dollars, and that's the result that they are getting. Obviously, it's not working well for them, and it's why we're seeing them decline. But furthermore, it's why we're talking and seeing them obviously complain about trade settlement and essentially doing anything that brings fairness to the market. They fight against the cat system because it's exposing their strategies. They're unhappy with the private trading rooms because they're not the ones making money, and they don't want trade settlement because, once again, this will then further decreases the ability to make money, and in fact will very likely make them lose money in their fundamentals. And you can see, what would the numbers look like if trade settlement was enforced. Now, one thing I do want to mention here is that in this particular thing we saw, so the net trading declined 8.4% in the second quarter. However, a booming first 3 months still generated an all-time high for the first half of 5.77 billion, the people said, asking not to be identified. Now, the problem with this is when we were looking back for February, for March, for those of you who've been on this channel for a long time, what we actually saw was how Citadel were forced to close positions because they were risky, because they were losing money. And remember, this isn't just me, and you guys can check the articles as well. They were forced to close over leverage and risky positions. And so it is something somewhat baffling to me to know whether or not that this number is actually true. Did they actually make, an all-time high for the first half? Or are they just saying this to make themselves look like they are in a good position? Because they were forced to close out positions in February. They were in the negatives in March. They were in a negative in April. So it's very hard for me to believe that they made an all-time high. Not to mention what we've talked about with Citadel in the past before is that multiple times they've claimed they've made tens of billions of dollars of profit. Yet, when it came to time to pay up to the investors, they needed to take loans in order to actually get money to then pay out to these investors. And the question we've always asked was, if you've already made so much money and you're not in risky positions, you're not in a place where you're tight for your liquidity, you've just made the tens of billions, you should have that spare cash to pay your investors. Why do you still need loans, especially loans that have very, very bad ratings? And so, we've seen them how potentially they are obviously saying things that in public it makes them look good, but actually behind the scenes it may not be so good, because I don't want to show the weaknesses in their capital, the weaknesses in their liquidity, because for these hedge funds it's obviously not a good look. And then you can see, I say again, if shorts delivered and closed on AMC and GME, why are there 1.1 billion total return swaps and the increases of 313 million of them across the year? What are you hedging if you have no position on AMC and GME? So this is the post we've shown in the past, which is looking at the swaps for January and against August for AMC. What you will see is that back in January, we had 843 million total return swaps for AMC. Bear in mind, this is just for AMC. But fast forward 7 months down the line for August, we had 1.1 billion total return swaps. So close to a 300 million total return swaps increase for AMC. Once again, why are the swaps still existent, firstly? And secondly, why are they increasing? If they were never trapped in this play, if they don't need these swaps, they would have closed out these swaps in the first place. And more importantly, the swaps won't even increase anymore if they are no longer trapped in this play. And so going back to what we talked about here with how Citadel is losing money, and then we're seeing an increase in the total return swaps, you start to understand what is actually happening. You start to understand how the puzzles are starting to fit into pieces right now, because we are seeing these hedge funds actually starting to crumble, and they're showing weaknesses, they're showing patterns, and it's just indications of what's actually going on. And then we take a look at this. Excellent analysis explaining current FUD with key objective to make retail exit as early as possible when AMC runs. Worthwhile to keep in mind is the AMC price when CEO Adam made the statement, and AA wants to retire as a winner. So we just talked about the crumbling down, the cracking down of these shorts. Slowly, they are running out of money. And like we've said, when they run out of money completely, they won't be able to suppress AMC. And when we're seeing this whole progress of them running out of money, we are getting closer and closer to real price discovery. And so what all of this means is Right now, every day, day by day, we are getting closer and closer to not only see the real price discovery, so what AMC should be when you factor in the fundamentals, when you factor in the market sentiment, when you factor in people's orders are actually having an effect on the market, we are also seeing how close AMC is getting to the squeeze. And so as we're getting close towards this, it is in short's best interest to make sure that the retail leaves, because they know that when this time comes, they'll have to pay us billions, and if not hundreds of billions of dollars, and they obviously don't want to do that, and it's why they're trying to force the retail to sell. As always, this is Ed Financial Advisor. They do take advice to grow so much to do your own due diligence and research, and I'll catch you guys next time.